everyone makes a lot of money during bull markets, but very few people manage to keep that money once the inevitable correction comes. And that's the big difference, I think, between professional traders and aspiring traders, is that professional traders learn to protect capital during times of smaller and no opportunities. As David Tepper likes to say, there are times to make a lot of money and there are times to not to lose money. Just knowing when to stay on the sidelines. It's very, very important in this business.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, it's Andrew here, and welcome to another episode of the Better System Trader podcast. This is episode number 88. It's really great that you could join us today, because today we're going to be talking about something that can really trouble a lot of traders. In fact, it can cause a lot of panic in the markets, and that is market corrections. Now, market corrections can be a stressful and challenging time for some traders, but it can also be a time of incredible opportunity. So how can we not only protect our trading accounts, but also grow our capital even further during times of market corrections? Our guest for this episode goes by the name of Ivanhoff, and he is the author of the book Crash: How to Protect and Grow Capital During Corrections. And in this episode, he's going to share with us some of the warning signs a correction could be starting and how to protect our capital during market corrections. He's also going to share the opportunities available during market corrections and how we can take advantage of those to grow our own capital. He'll also discuss with us the characteristics of corrections and how they're changing over time, and also the possible impacts this could have for future market corrections. And then we're getting to finish up the conversation discussing current market conditions, and there's some interesting things happening in the markets at the moment. So Ivan's going to share what he thinks this could be telling us. So it's a very interesting and valuable chat that we're having with Ivan today. It's not something that you want to miss. But firstly, let's hear a quick word from our sponsor, tradingmarketinternals.com. Learn how to reduce drawdowns, adapt to changing market conditions, and improve the overall performance of your trading strategies using the power of Market Internals. Download your free Market Internals starter kit from tradingmarketinternals.com. I've used this myself with great results, so go check it out. That website again, tradingmarketinternals.com. Or I have a link on the show notes page at bettersystemtrader.com/88. And now over to our chat with Ivan. Hi Ivan, thanks for coming on the show today. It's really great to have you here, so welcome.
Hey, thanks for having me, Andrew.
Now, I'm really excited to be speaking with you today because I think the topic that we'll be discussing is a very important one, and it could be very timely. But first, before we get into that, how about we start with a little bit of your trading background? So can you share with us the story of how you got into trading?
Yeah, sure. I was born in Bulgaria, so naturally my first trading experience was trading in the local market. And I got involved a little bit after high school. I bought a couple stocks because at the time, most emerging markets and the markets in Eastern Europe were pretty hot because of foreign capital entering those markets. And you can find a lot of information in the local press about the stock market. So I got interested. I invested a little bit of money that I had in two stocks, and one of them doubled, the other went up 50% in 3 months. And I made a little bit of money, and after that I moved to the States to study. And I started to read more about the stock market, and I opened an account in the US in 2005. With just $2,000. And so I started super small. And I actually remember ironically, my first trade was an options trade. I bought some calls in Dell. And I lost like 50 or 60% on my first trade. And, I had no methods, no system at the time. I had no idea what I was doing. I was just, reading everything I can find on the stock market and just learning by making mistakes, I guess. So the first couple of years were pretty rough while I was, learning. I mean, luckily I was trading with a small capital, so that's how you learn best. When you risk, when you don't have a lot of money at risk. So the first profitable setup that I encountered was it's called post-earnings announcement drift. I started reading about it. There was a whole book, I don't even remember the name now, that explained how stocks tend to continue in the same direction after their earnings gap. For example, when a stock beats earnings expectations by a large margin, and on the next day it gaps up, which means that the market is reacting favorably to that new piece of information, that stock tends to continue in the same direction for 2 to 12 weeks after that. So this was then I gradually started taking those types of trades, and I started making money. And I'm using this approach even to these days. I mean, of course, nowadays I've also adopted some other ways to trade, but this is pretty much the first profitable approach that I found.
Mm. Okay, so if we fast forward to today, can you just give us a little bit more information about the markets that you trade and the I guess the particular styles that you use when you're trading?
Well, my styles differs depending on the market, because the market changes all the time, and different styles, different setups work in different markets. For example, in a raging bullish market, I like to be long recent IPOs because of their small float and favorable supply-demand dynamics. They tend to move a lot in a short period of time. It's not unusual to have a recent IPO that would move 50% in a month in a raging bull market, especially if it belongs to a hot industry. I also like to trade high volume range expansions, high volume breakouts, because if you study the best performing stocks over a 1 month to 12 month horizon, you will notice that one of the things they have in common is that at the beginning of their move, they start with a huge volume expansion. Like I'm talking 10 times, 20 times their average daily volume. So there is a volume expansion and a price expansion, and that usually kickstarts a big move, especially if there is real earnings related news behind the move. So in a range bound markets that are choppier, like we are currently in such a market, I tend to trade less. I use a smaller position size. Sometimes I dabble into intraday trades, and that's true especially during market corrections when volatility jumps and we see huge intraday moves. Then in that environment, I would sometimes trade intraday. So basically, I would qualify myself as a swing trader, someone who is looking for short-term moves that last anywhere between 2 to 20 trading days. And then depending on the market, I'm using different setups. And as I mentioned, I'm still looking for stocks that react favorably to their latest earnings. And or sometimes I can also short stocks that have negative market reaction, but that's more rare. I pay special attention to industry relative strength because if you're in the right industry, like that takes care of, like all of a sudden if you're in the right industry, you realize that risk management is a lot easier because stocks tend to move in groups. And when you figure out what industry is currently hot, as semiconductors have been super hot, since last summer, up until last week, it's a lot easier to, and then you focus your attention to that hot industry. It's a lot easier to manage risk.
Okay, cool. All right. Well, thank you very much for that background, Ivan. Now, as I mentioned earlier, I'm pretty excited to be speaking with you today because I just finished reading a book, actually probably a few weeks ago now, but it was a book that you published and it was called Crash: How to Protect and Grow Capital During Corrections. Now, I think market corrections can be a time of challenge or stress for some traders, but also an area of opportunity. And I found that your book had a lot of interesting points in it. So I hope you don't mind that we can have a chat about corrections a little bit today. So are you cool with that?
Yeah, absolutely. I'm ready for it.
Awesome. So how about we start with some of the basics then? If you can perhaps explain what is a correction, or how do you define a correction?
I mean, a correction is any drawdown that is, I guess, more than 8% in a major markets index like the S&P 500. In corrections, such types of drawdowns, they happen every year, at least once a year. And this is why it's so important to learn how to deal with corrections. sometimes they turn into much deeper pullbacks, 20%, 50%, which is a lot more rare, but it happens. If you look at let's say Russell 2000, which is the small cap index here in the US, over the long-term perspective, that index has absolutely outperformed any other diversified index in the US, by a big margin. But then their average or annual drawdown is close to 20%. So we have big drawdowns in the market almost every single year. So if you think that you can just buy and hold, passively hold a well-diversified index, and you won't experience any volatility or big drawdown, you're in for some surprise. Corrections, as I said, they happen every year, in one form or another. But the thing about them is that they create incredible opportunities. Not so much. I'm not saying that so much on the short side during the correction. I'm saying after that. I have a favorite saying from Peter Lynch, who says that he says, I don't know what causes deep market corrections, but without them, all amazing stock market records, track records will not be possible without them. So we need corrections. They create incredible opportunities for all types of traders, for intraday traders, for swing traders, for value investors, for position traders. Corrections are needed.
Okay, so before we get into the ways to manage and perhaps the opportunities of corrections, can you explain to us a little bit about the signs that a correction could be coming?
Yeah, there's some signs that can improve your odds of figuring out when it starts. But in general, guessing market tops is a lot more difficult than market bottoms, for the simple reason that stocks tend to top individually but bottom as a group. And I say that they bottom as a group because during corrections, usually correlations go to 1.0. So most stocks and assets move together up and down. While, during the bull market is usually a market of stocks, a low correlation market of stocks. So the different stocks will top at different times. So, of course, one of the signs of coming correction is a worsening market breadth. When you see that the stock market keeps making new high, but with fewer and fewer stocks, involved. But that so-called, breadth divergence can continue for a very long time. It can continue for a year. So it's not an exact science. I think, personally, I become a lot less aggressive in the markets and on the long side when all major market indices like the Nasdaq 100, the S&P 500, the Russell 2000 start trading below their 10-day moving averages, and especially below their 50-day moving averages. So that's for me is a sign for caution. And I'm a lot less aggressive on the long side. But as I said, I'm talking from the perspective of a swing trader. And the way I approach the market might not be your approach. If you're a value investor, you approach the market differently. Another sign is that I'm looking at the performance of my trades. If all of a sudden I see a big spike in reversals in my long trades, in my, let's say, breakouts, then I know that the market has changed. If all of a sudden I see that 70% of my trades are losing me money, there is an obvious distribution in the markets. So the thing about correction is, the good thing is that the markets rarely go from, being in a bull markets to being in a correction mode. Usually there is a middle period of distribution, which gives you plenty of time and signs to raise some cash and become less aggressive, at least on the long side.
Yeah, so are you saying there that during those times it's typically a choppy time between a bull market and perhaps a correction?
Yeah, exactly. You have choppier markets. You have many breakouts that are failing. You have breakdowns that are failing, as the bulls are not willing to chase breakout in the major indices, but they're willing to step in on dips. So you have that choppy market behavior where the market is looking for direction, and if you're very active in this type of market, just you can cause a lot of damage to your accounts.
Yeah. So what are some of the ways that you can protect yourself then during those kind of choppy market times?
The way I approach it, I cut my position size in at least half or even more. I become less aggressive. I trade less. Look, drawdowns are inevitable. You have a drawdown. The question is how big of a drawdown. It's one thing to have a 5%, 7% drawdown. It's another thing to have a 50% drawdown. If you're an aggressive trader, everyone makes a lot of money during bull markets, but very few people manage to keep that money once the inevitable correction comes. And that's the big difference, I think, between professional traders and aspiring traders, and is that professional traders learn to protect capital. During times of smaller and no opportunities. As David Tepper likes to say, there are times to make a lot of money, and there are times to not to lose money. Just knowing when to stay on the sidelines. It's very, very important in this business.
Yep. That's an excellent point you make there, Ivan. Now, how about we chat about what actually happens in the markets during a correction? Now, you just mentioned that correlation aspect of it, but what about other functions of the market like volatility, and you also touched a little bit on market breadth, but what actually happens in the markets during a correction?
I mean, you're starting to see sector after sector, getting sold off. And usually the market leaders are getting sold last. And that's why many people have, if you're owning the leaders, you might have the illusion, the market is falling apart, but, my, 5 stocks are not. So everything's fine. People, if you're owning the leaders, you don't care. And actually one of the signs of a coming short-term bottom is when the momentum the actual leaders like you have your Amazon and Facebooks of nowadays, when they sell off, because when they sell off, they always usually sell off during periods of forced liquidation. When institutions sell not because they want to, but because they have to. Meaning margin calls and just other reasons. So actually, when you see that last leg is when, I'll take you back to the last sizable correction in early 2016. If you remember how the market had the first 3 weeks of 2016, it sold off super quickly. But then during that time, you had stocks like Amazon and Facebook, Microsoft. They held relatively well. And then you had a quick bounce, which pretty much recovered 50% of that 3-week correction. And then there was another leg lower. And during that other leg lower, which was in early February, those stocks that managed to hold in January, they got crushed. All those big tech leaders, they got absolutely crushed.
Okay, so you just mentioned there are a couple of signs that a correction may be ending and recovery could be beginning. Are there any other things that you look for during that phase of a correction?
Okay, so let's talk about volatility exactly. So, naturally, volatility rises. One of the most followed indicators here is the so-called VIX, which represent the S&P 500 options volatility. And during corrections, usually VIX futures go into backwardation. Usually in most of the time, VIX futures trade in contango, which means that let's say the VIX May futures are higher than VIX April futures, which is normal because they're further in time.
Yeah.
So during corrections, that futures curve inverts, and you have that backwardation when the most recent, the front month VIX futures have a much higher level than the second, the third, sometimes the fourth or the fifth month. This is a sign of institutions buying protection for their portfolio, buying put options, and that purchasing of put options that increases the implied volatility of those same options, and that's why the front month VIX spikes. And during those times, there is an ETF, VXX, which follows follows the VIX. So over the long term, that's a terrible ETF because of the so-called contango. It's guaranteed if you own VXX in a long-term perspective, you're guaranteed to lose money. That's why it's probably down 99% since inception, exactly because of that futures curve. So during correction, of course, volatility spikes, and one way to protect your portfolio is to go long volatility. That same crappy ETN VXX, could be a great hedging instrument or a short-term speculation vehicle during corrections. Because when the VIX futures go into backwardation, now all of a sudden everything that is wrong with VXX, now it's on its side. So I don't know you have to be a little familiar with options and with VIX futures to understand what I'm saying. But either way, being long volatility during corrections is one way to protect your portfolio or to make some money during those times.
Yeah. Okay. All right, and so that's the protection during a correction. Now, what about, you already touched on this a little bit, but when you do start to see some of those signs that perhaps a recovery is beginning, what techniques can you use to try and profit from that market condition?
Okay, so we'll take the reverse trade of volatility. So there is a ETN, which is inverse VIX XIV. So when the market reverse, So first of all, volatility tend to tops several days to several weeks after the market bottoms. So the volatility is a lagging indicator. And how lagging, that depends on the severity of the correction. For example, the last big correction in 2016, the market bottom was around February 11th, 12th, and then VIX topped a few days later, about February 17th. So that's the good thing about this approach, that the volatility is always lagging. So the moment you see that you have some breadth divergence, and you see the market spiking, and you wait a few days until VIX futures go into contango again, and then it's a good time to buy XIV, which is the inverse VIX ETN, and you can hold it for multiple weeks or multiple months after that. If you look at its chart, it tends to recover pretty quickly. I mean, last year in February, XAV was under $20. It went to close to 80 in January this year. So you can see some huge swings. That's the easiest way to play it. And of course you can, as I said, corrections create incredible opportunities for all types of traders, disregarding of your time horizon. After corrections, the two best performing stock groups are the ones that got hit the worst and the ones that held the best. Usually every correction is led by one major sector. For example, in 2015, 2016, it was the energy sector and emerging markets. In 2008, 2007, 2008, it was financial stocks. And in 2000, it was the technology stocks. So and every correction is led by one sector that got absolutely demolished. Some that it will have stocks that will go down, 80, 90, 95%. So during the initial stages of recovery, those types of stocks can have gigantic moves, and I'm talking 100 to 300% moves in 1 to 3 months. The other way to approach it, if you are afraid of buying stocks that are down so much, 95% from their all-time highs, is to pay attention to the stocks that held the best during that correction, that managed to stay within 10-50% from their 52-week highs, and they just built a new base. Usually those types of stocks, they're among the first to make new 52-week highs, like days after the market correction is over. For example, in 2009, 2 days, in March 2009, 2 days after the market bottomed, 3 stocks made new all-time highs in the entire market. Only 3 stocks, and those stocks were Netflix, Green Mountain Coffee Roasters, and AutoZone. Netflix and Green Mountain Coffee Roasters, they went up 1,000% in the next 3 years.
Wow.
2 to 3 years, and they were the first one to make new high. That's all you need to do, to pay attention to which stocks are going to make new 52-week highs after the market bounces. You don't even need to guess to catch the exact market bottom. You just need to pay attention to which stocks make new 52-week highs, a few days after that. And AutoZone also did amazing. They also, I think, tripled from that point pretty quickly. In 2016, you saw absolutely the same thing. Stocks that kind of went sideways while the market was crashing. For example, that stock with the symbol COHR, like in January, it had very strong earnings report, and it attempted to break out to new 52-week highs. But then the market was crashing, so it basically went sideways for a few days. From there, that stock went up more than doubled in the next less than a year. So you keep seeing the same patterns over and over again after market corrections. The stock that were hit the worst and the stock that held the best will usually deliver the best return for the risk taken. And as I said, if you don't feel like picking individual stocks, you can just go with that inverse VIX CTN XIV after the VIX futures go back into contango, and just you get pretty good return with very little effort. I mean, apparently nothing is guaranteed, and keep in mind that ETN is super volatile. It's super normal for it to go up or down 20% in a week. So it's not for the faint of heart, but it's just one way to approach it.
Yeah, it sounds like there's a lot of opportunity there. Now, I just want to jump back to a statement you made earlier. You may have to correct me if I'm wrong here, but I think that you said that one of the signs that a correction could be ending is when you have those market leaders, they get hammered pretty quickly because of forced selling. Now, have you noticed that the market leaders before a correction end up being the market leaders after a correction as well, or does it change as a result of the correction?
It depends on the severity of the correction. In a normal garden variety pullback, which is like 10%, yes, you see those leaders bounce back and continue to lead the market. But after a deeper correction, usually see a new group of leaders.
Now, I wanted to ask you, so earlier you said, that a correction could be 8% and it could be 50%, which is quite deep. What's the difference between a correction and a bear market? Like, how do you determine when one is turning into the other?
Well, you don't really know in advance. There is no way for you to know that a 20% correction will turn into a 50% bear market. That's why they're so rare. I mean, there's apparently a lot of sentiment and psychology involved in that. Who knew that in 2007, 2008 they'll let Lehman go bankrupt? No one knew that. You cannot predict that. So you have a sequence of events that need to happen for a deep correction to turn into a bear market, which is, I don't think you can predict in advance. But as I said, the market gives you plenty of signs and opportunity to raise cash or to change your market approach and focus on intraday trading. Let's say during those volatile time. So a deeper 50% correction doesn't affect you or affect you positively. There's just no way to know which if a 20% will turn into a 50%. All we know that these are very rare, and when they happen, if you manage to protect your capital after that, the opportunities after that are just tremendous. Like, you can build incredible wealth after a 50% correction. I mean, I wish there is another 50% correction, but to happen now, because with the knowledge I have now, I'll be able to capitalize on that a lot better. And I'm sure that in our lifetime we'll see at least a few of those. It's just the way markets work. What is different nowadays, I think, is that is correlations. Right now, passive investing, indexing accounts for about 40% of the market, which is, and this percentage has been growing more and more, which means that correlation will be even higher, which means what? That during bull markets, you'll see crappy stocks go up a lot, along with the high quality stocks. And during bear market, you see super high quality stocks go down a lot with the rest, which creates it will create even better opportunities for stock pickers. If we go back to the two big, bear markets of the past 15 years. So in 2002, that market, the bear market was led down by technology stocks. But during that bear market, you had plenty of stocks that were not correlated with the rest of the market. For example, Panera Bread, which was recently acquired, they made new all-time highs in the midst of that market crash, and that stock went up several 100% during that correction. So you had plenty of stocks at the time in 2002 that did not go down with the market. So if you were just paying attention to what is going on the 52-week high list, you would have spotted plenty of growth opportunities, to participate on the long side. In 2007, 2008, we had a completely different situation because all stocks were destroyed. The Googles and the Apples, it didn't matter that they continued to grow their earnings at 100, 200%. That didn't matter. Like all of them got sold off, and I'm thinking that the last bear market is more of a better representation of what we can expect in the future because of the higher correlation nowadays. That during a severe bear market, we see most stocks just slammed significantly.
Yeah. So do you think that increasing correlation in corrections over time is likely to lead to deeper corrections in the future, or what do you think would be the outcome of that kind of trending correlation?
Yeah, I think deeper corrections and also very aggressive recoveries and stronger bull markets in general. And also, as I said, the stocks will move, the correlation will be super high between all stocks and most asset classes. So it will be really hard to find a place to hide. I mean, the only thing that we know for sure is that volatility will spike, and you can protect your portfolio by being long volatility or by being short. During bull markets, the market makes higher highs and higher lows. So buying the dips is a system with an edge. During bear markets, when the major indices are trading below declining 200-day moving average, you have lower highs and lower lows. So selling rips and reversal is a system with an edge.
Yeah. Now, I just want to jump back again to the difference between a correction and a bear market. What's the difference between a 50% correction and a bear market that goes down 50%? Can you kind of tell us the distinguishing factors between those two?
It's more of an art explanation than science. Like for me personally, a bear market is when a major index spends more than a year below its declining 200-day moving average. That's my definition. And in the meantime, it goes down 30, 40, 50% or more. That's a bear market for me. There's no exact definition. It's probably different for everyone. I mean, there is an anecdote that in bear markets you buy when the fear of losing is the highest, and you sell when the fear of missing out is the highest. In bull market, you buy in both cases, when the fear of missing out is the highest and the fear of losing is the highest. So that's a big difference. You need to be a lot more tactical during corrections and during bear markets.
Yeah. I want to ask you one final question before we start wrapping up for today, and that is the conditions in the markets today. So as you mentioned earlier, the previous correction was in early 2016, and that they tend to happen every year. So that was about a year ago now, maybe a little bit more. What are you seeing in the markets today, and what do you think? We're not trying to predict the future, but what do you think is happening in the markets, and where do you think that's likely to lead?
Look, the correction in 2016 wasn't a small one. It was a significant, almost 20% correction. What I'm saying that every single year it's normal to see a 7, 8 to 10% pullback, which is not that severe of a correction. lately, what I'm seeing is that the stocks that led the market after the U.S. elections, like industrial metals, transportation, they're getting hit pretty hard. The only standing momentum leader up until last week were semiconductors, and they're also under pressure as of late. So there are less and less leaders left. So unless we see a major sector rotation, that a new sectors that can lead the market higher, we can see a deeper correction. I mean, a market can definitely correct through time as well. So we can just remain in a like choppy wide range without a clear direction, which is even worse trading environment and more challenging than just having a correction that is done, and that is 3-4 weeks and it's done. There's no way to tell. I mean, from what I can see is that the breakouts in the major indices, in the Nasdaq and the S&P, are getting faded, but that in the same time, deep buyers are still active. There is an underlying beat in the market. And this is why lately we saw such a big spike in VIX. It's really interesting that as of right now, early to mid-April, VIX futures are actually in backwardation, and they haven't been in such deep backwardation since early 2016. Basically, there is absolutely no complacency in the market. People were afraid, and they've been buying a lot of protection, a lot of puts to protect their portfolios. And that's why we saw that huge spike in VIX and in put options implied volatility. So people are prepared. So which means that if the market keeps going lower, they're less likely to sell their shares because they're already insured, they're already hedged. Now, so I'm thinking that we'll just see. I think the worst case scenario is more choppiness. I don't really expect a big 15-20% correction, but you never know. Anything is possible.
Okay. All right. Thank you very much for your take on the markets at the moment, Ivan. That's really interesting to hear your point of view there. So appreciate that. Thank you very much.
Thank you.
Okay. Now I'd just like to start wrapping up with a few quick closing questions.
Okay.
What's the biggest lesson that you've learned through trading?
The biggest lesson is that different setups work in different markets. The very same setups that can make you a lot of money in a rising market are setups with no edge in a choppy market or in a declining market. So you have to pay attention to your environment. The market plays the music, and when the music changes, you need to change the way you dance or just step on the sidelines, because you're going to lose money if you keep doing the same thing. The definition of they say that the definition of insanity is doing the same thing over and over again and expecting different results. Well, in the market, if you do the same thing over and over again, you're guaranteed to get different results, just because the markets are constantly changing. So that's the thing. Paying attention to the different types of markets is super important. I think the most important thing for a trader. And the second important thing is to look for industry relative strength. There are always industries that are leading the market up and down. And if you focus your trading efforts in those leading sectors, all of a sudden you'll notice that risk management will become a lot easier and trade, and your returns will improve substantially.
Okay, cool. Thanks, Ivan. Now, what's the best trading advice you've ever received?
The best trading advice? Well, studying success. I mean, you can do that by studying great traders and their approaches and how they evolved over time and what books they read and what are they writing about now, if they have social media accounts or a blog. And also, and even more importantly, studying your own trades, your own winners and losers and figuring out how you can improve, and also studying past winners and losers in the market in general. Like one of my favorite exercises every week is to look at all the stocks that went up or down more than 10% for the week or more than 30% for the month. And then I look, what do they have in common? And then depending on the market, they will have, different things in common. Like, right after a market correction, you'll notice that, most of the best performance will come from, the worst hit sectors or the ones that, held the best. In a rising market, you'll notice that maybe they belong to a certain sector.
Yeah. Okay, thanks. And what about, do you have any favorite trading books?
Yeah, I have many different trading books that are favorite of mine. I read a lot. I wrote several that people can check out. I think people are super lucky nowadays that there is so much high quality information that you can buy, for $10 on Amazon. It's just insane. I think all Jack Schwager book, the Market Wizard books give really good foundation of market history and psychology. I enjoy to read the work of Dr. Brett Steenbarger, who is a trading coach and psychologist. He's super insightful, and through him, I can look the market from different perspectives. What else? Inside the House of Money by Steve Drobny. It's kind of a version of similar to Market Wizards, but he focuses on macro hedge fund managers. The Wall Street Edge by Howard Lindzen is also very light read. He talks about how he uses the all-time high list to find good long-term investments. I think the more you read, the more that trading knowledge will compound, and then you can borrow from here and there and create your own approach that will fit better who you are. It will fit better your strengths.
Yeah, I agree. I do a lot of reading as well, and I think there's lots to learn. Definitely a valuable thing to do. And okay, now, so what's the best way for listeners to learn more about you or from you?
I'm pretty active on social media, so people can find me on StockTweets or Twitter. My handle is @Ivanhoff, Ivan Hoff. I also have a personal blog, ivanhoff.com. You can send me an email through that, and that's it. These are the main ways to approach me.
Awesome. All right. Well, thank you very much for your time today, Ivan. Now, is there anything else that you'd like to mention now before we wrap up for today?
Maybe there's nothing I can think of right now.
We've had a pretty thorough conversation today. So, thank you very much for that. We really appreciate you sharing some of your insights into corrections. And as you mentioned, we've got some interesting conditions in the market at the moment. So it'll be very interesting to see how it all plays out.
Definitely a lot more challenging. Like the first couple months, maybe even 3 months of the year were, very, very easy trading environment. It was very easy to make money, and all of a sudden, about mid-March, I noticed even in my returns how the market just changed, and the setups that were making me money all of a sudden started losing me money.
Yeah, I agree. Very interesting times. I think that when we release this podcast episode, could be perfect timing, but we'll see. We'll see what happens in the markets. But thanks again for your time today, and I wish you all the best.
Thank you for the opportunity. Thank you.
Thanks. Cheers, Ivan.
Okay,
so a big thanks to Ivan for sharing with us today. We definitely have some interesting times in the markets at the moment, so it'll be interesting to see how it all plays out. But I hope that the chat with Ivan today is kind of helps people to think about how or come up with a plan on how to protect capital and perhaps even grow it during times of market corrections, which will undoubtedly come at some point in the future. So thank you very much for that, Ivan. If you want some more information, we do have some on the show notes page at bettersystemtrader.com. ivanhoff.com/88. And I recommend you take a look at his book Crash as well. So I've got a link to that on the show notes page as well. So that's it for this episode. I'll catch you again next week. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.